Well, good afternoon, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house, coming to you from beautiful, sunny Coachella Valley. Palm Springs is where our headquarters office is. So I want to welcome you to the show this week. It's a pretty toasty wintertime here in Palm Springs. We're right around 80 degrees. We're going to get up into the 90s early next week. So we got a little bit of a heat wave approaching. In the meantime, I want to go ahead and give you the update on mortgage rates in the bond market. We always start off with that. Jeff's going to pull up our rate grid from our website. That's right there on the home page. There you can get a good indication as to where mortgage rates are on different loan products, conforming conventional, FHA, VA, and jumbo, as well as equity loans. And you can see here that, interest rate wise, things are just holding steady. We are still, like we were last week, in the mid sixes for conforming conventional loans. We're now back under the 6% range for FHA and right around 6% for VA. And those equity loan rates are actually pretty darn good, which we're going to talk about a little bit later in the program. So in terms of where rates are this week, the backdrop to that is going to be, of course, economic data, as well as looking at the 10-year Treasury bond chart. There you see it. Jeff just pulled it up. And as you can tell, I mean, going back to last Friday to today, we had a pretty good little dip on Monday and early part of Tuesday. Then a pretty sizable increase on Wednesday. And then, of course, we're kind of gradually coming back down on Thursday. It's interesting overall that this chart shows you a relatively stable range in terms of mortgage rates. And I've been saying lately, I think we're going to be seeing this for an extended period of time. In terms of economic data or news that is a backdrop to these kind of bond yields and mortgage rates, there's a few things that came out this week. We had a relatively light calendar in terms of data points, but the primary driver in terms of bond yields and mortgage rates was the release of the minutes of the Fed's January, the Federal Open Market Committee meeting. And the minutes were interesting because they underscored what we've been saying now more recently that I think is going to be the case for some time. They want to see more inflation more under control before cutting the Fed funds rate further. That was pretty clear in the minutes. So anyone thinking that we're going to have a soon to be coming reduction in the Fed funds rate, looks like that's off the table. The Fed is, while happy with the progress of inflation, we're still in the low threes. They're trying to get to 2. And until we see some more concrete evidence that we're breaking through 3 and heading toward 2, it's looking like the Fed's going to kind of stand pat and not be looking to cut the Fed funds rate anytime soon. The Fed is also concerned about the current administration's tariffs. Those could push prices higher, which of course would be inflationary. That would be another reason why the Fed's going to take a very cautious approach. Based on those minutes, now the prediction is that a Fed funds reduction, if it occurs at all this year, and if it does occur, at least the next one, probably not going to be more than 0.25%, is going to be mid to late 2025. So again, there's another signal that we're probably going to be at these levels for an extended period of time. So if you're waiting for lower rates, as it says at the bottom, on rates higher for longer, that 5% or 4% mortgage is not around the corner. Other data points this week, interesting news, existing home sales are going to come out on Friday. The projection is that they'll drop a little bit down to 4.13 million. You remember last month they actually upticked a little bit over 4.2 million in December. So January, the forecast is that it's going to drop a little bit, 4.13. Of course, it was only a couple of months ago that existing home sales on a monthly basis were under 4 million. So we're kind of scratching back, but we got a ways to go. Normal market, if you will, quote unquote, is more like 6 million existing home sales. So we're still, only 2/3 of the way there. And then, of course, on Friday, also the S&P, that Standard & Poor's Flash U.S. Services and Manufacturing Index, Purchasing Managers Index, that is forecast to be flat. So my prediction on rates is we're going to be kind of holding steady at these levels. It's going to get kind of boring, folks. I think we're going to be, not seeing a big swing either way, barring some, unforeseen circumstance or shock data point. So I think we're going to be at these levels, kind of ho-hum, humdrum, at these levels for an extended period of time. But I think ultimately that's good news. It's better that we have sort of a stable market that'll help people manage their expectations. And hopefully for those of you who want to buy a home, I think it really is time for you to consider doing that. Get off the fence. Let us help you, show you what can be possible in terms of financing that purchase, given where we're at in rates right now. So with that, I'm going to go ahead and have Jeff come back up so we can start our discussion about home equity.
Hi, Art. Can you hear me there?
I can. Go ahead.
Okay, good. Yeah, one of the things that, especially since I am probably near that retirement age, and I see a lot of my friends out there that I can't believe I'm saying that. Yeah, I never, I still keep throwing those what's it, AAA away about, signing up for AARP. I'm like, that I'm not ready for that. I'm like, crap, I am kind of ready for that. Anyway,
I can relate.
I see a lot of people out there that are, when you really kind of scrape away the fun in life and whatnot, they have a little bit of concern about, hey, what retirement is going to look like. And so that's why I really wanted to have a discussion with you about this today, and not to have a downer session, but actually some of the things that you pointed out and going to point out are really some good signs. So I'm excited about that. And as it says, how to retire with less stress and more financial flexibility. So I've got my pen and paper out, but I've got a few questions I want to ask you about that, because I've got some concerns about that.
Okay.
One of the things that I thought was interesting, it was this little note here. Homeowners age 62 and older collectively hold approximately $14 trillion in home equity. Now, that sounds like a lot of zeros, Art.
Well, yeah, that's more zeros than I can count, I think. But that is really a tremendous number when you think about it, and I think it's an important number. I think what in the media, the news, there's so much negative news about housing and home ownership, how difficult it is, and the affordability challenges and so forth. Well, a little bit of the silver lining, particularly in the past 5 or 6 years, we go through that pandemic, and yes, home prices have jumped quite a bit, which has made buying a home more of a challenge. That combined with our higher rates, that we have now versus a couple of years ago. But there's another aspect of home ownership where that phenomenon over the last 5 years or through the pandemic with prices going up has been a boon to existing homeowners, as this number portrays. I mean, and that number, relatively speaking, is a very big number when you consider it's only those who are 62 and older. Now, granted, the baby boom generation is considered to be growing, and in fact, I think it might be one of, if not the largest generational segment we have right now. But nonetheless, 14 trillion is a lot to go after. But the question is, for a lot of these homeowners, and at least more that I'm seeing lately, is it can be a challenge getting their hands on that equity. In some cases, we're seeing, folks who are, 55, 58, 60, and so forth, they own a home. They've got a small mortgage. They refied at 2.5% in 2021, and they got several $100,000 of equity. Well, the first thing they would try to do is look at maybe getting an equity loan, like a fixed rate second mortgage or a HELOC. That actually can be somewhat challenging because of underwriting criteria. And so for the 62-year-old homeowner, 62 or older, the good news is there are other, I think, products that are more directly related to their needs, and are actually products that are easier to get than some of the traditional equity loans. And what I'm talking about, of course, is reverse mortgages. The standard core product being the HECM, the home equity conversion mortgage. That's an FHA product. And then a more recent addition to reverse mortgage products in general is a second mortgage. That is a reverse mortgage type product. It's called a home safe second. So the idea is, for that 62-year-old homeowner, age 62 or older, if you're having trouble with those traditional equity loan options like a HELoan, a fixed rate second, or a HELOC, these other reverse mortgage like product are a perfect alternative that in a lot of cases are actually easier to get, and will help them tap into this tremendous amount of equity that they have. Because, certainly when you get to be 62 plus, it's less likely you're going to sell and move into another home at some point. So now you're kind of focused more on, as they say, aging into your current home. And what we can do is help people do that with some of these financial products.
Well, you mentioned 2021, and keep this number 14 trillion in mind. Back in 2021, kind of I'm going to say at the onset of the pandemic, it said it increased from $9.2 trillion in the first quarter of 2021. I mean, that's $5 trillion in added equity in that specific group, 62 and older, which again, it kind of gives me goosebumps because I'm in that group and I experienced that. And I have to share that you helped my wife and I with exactly this particular situation where we said, hey, we've got all this equity in our home. We want to do some things in our home. But here was our mindset. This is me. I'm like, I don't want to have to work forever. I'd rather not have to pay anything back. And you said, well, geez, Jeff, there's an opportunity with this reverse mortgage. And it's an option, as you said, to make a payment. And it made such a difference for us to be able to get the equity out of our home, get some things done, some significant things, and not have that stress of, oh, geez, I've got to take on another payment for a line of credit. How many people do you talk to when they're thinking about getting, they're that group 62 and older, that's kind of one of those things that they shy away from? I don't want more payments.
Well, yeah, I mean, that's the dilemma, right? Because when you get into the older homeowner situation, there's a couple of different types of profiles we're running into. One is someone who is approaching 62 or older, and again, even 55 plus, and they may have had a change in their income in recent years. They may still be employed, but maybe the income isn't quite what it was. They've gotten in a situation where maybe they've accumulated a little bit too much debt. And so the natural reaction most often is a homeowner is going to say, well, I need a HELOC. Well, and of course, we always start there. HELOC, a traditional, equity loan, you're going to get that loan, whether it's a fixed rate second or a HELOC, a home equity line of credit, where you can tap into some of it initially and then have a remaining portion to use later. Well, we would start with that, but what happens is sometimes the underwriting criteria for those don't quite work. For one, HELOCs, HELoans will have a higher credit score requirement. Typically, if you're not at least 640 to 660, you're not going to get at least that or higher. You're not going to get a HELoan or a HELOC, a traditional one, because your credit score is too low. Plus the fact that, especially on the HELOC side, your qualifying criteria includes calculating a debt ratio. And because many of the HELOCs are variable rate loans, you don't qualify at the actual initial rate. They pump that up, like the initial rate plus 2%, and then over a shorter amortization period to create what is a higher sort of artificial monthly payment used to calculate your debt ratio. Now, why would they do that? It's because it's a variable rate loan, and over time the rate could go up. Doesn't look like that's going to happen anytime soon, but that underwriting approach takes into account you may be having to deal with some increases in your required monthly payment if the variable rate HELOC starts to go up, because it's tied to prime. Anytime prime changes, that rate will change as well. And of course, the current environment, the hope is it's going to go down, but it could go up again in the future. So we try that first. Then what happens is, either because that senior homeowner's income has dropped a little bit, or maybe they've converted to retirement income, they can't meet the HELOC or HELoan requirement in terms of debt ratio. Or the other thing we see quite a bit of, you're approaching, that retirement age, but your late 50s going into early 60s. The other profile we see a lot is a homeowner with a lot of equity, a small mortgage, 2.5% mortgage rate that they refied to 3 years ago, and they're self-employed. They're very successful. They're running a very successful business. But as a self-employed borrower, we all know, or at least folks who pay attention to this program or you've been involved in getting a mortgage at all, a self-employed borrower can be a challenge in qualifying you for conforming loans. Why? Because of the debt ratio requirement. And because when you're self-employed, the income that we have to use for calculating that ratio is not your gross revenue from your business, which would be, you would think, equivalent to my gross salary when if I'm working for a company. Well, it turns out they're not handled the same way. When you're self-employed, it's not your gross revenue to meet that 45% debt ratio. It's your net income
Mm.
after you deduct all your business expenses from that gross revenue. And the idea and the that approach is logical if you think about it. If you're going to provide tax returns, and the lender is going to look at that and say, well, if you generated $800,000 annual gross revenue in your business, but you had $750,000 of business expenses that you declared against that 800, leaving 50. Well, we have to calculate your debt ratio off the 50 because, after all, we have to believe your tax return that 750 in expenses is spent money and not available to make a mortgage payment, right?
Mm.
And so that's what you run into, is then you suddenly don't qualify because your debt ratio is not 45, it's 85, because the 50,000 net isn't enough to cover. Maybe you need 150, $200,000 HELOC because you're going to do some, substantial stuff, remodel a kitchen, solar, build an AD or whatever it might be. And so you run into a problem. Well, the reverse mortgage product, that's the that's the product as the solution. And again,
Mm.
we can do a HECM that would replace your existing first. But again, you may have a 2.5% mortgage. You're handling that payment fine because it's a modest balance. But you want to get that equity. You don't want to touch that 2.5 rate. So you don't go with the HECM because it's a first mortgage. It would replace your existing first mortgage and get you access to additional cash, depending on your age. The older you are, the more you get. But the more common option that we're seeing and doing now is the home safe second. What's so great about the home safe second is you don't have to even be 62. You only need to be 55 plus.
Mm.
The other thing about it is, yes, there's a credit score requirement, but it's very low. It's 600. And if you're 720 or higher, you're in tier one. Below 720, you're in tier two. So if you're below 720, we do have to document your income. We are going to look at a debt ratio, but if the debt ratio doesn't work, we can use residual income. In other words, how much money is left in your monthly household budget after deducting your expenses, your housing expense, your consumer debt payments, and then based on your family size, if your residual income is adequate, doesn't matter what your debt ratio is. So that's one benefit, qualifying benefit, underwriting benefit from the home safe second. The other one is if you're 720 or higher, it's stated income. We don't even have to
Mm.
document your income. and and then the biggest benefit of this is the flexibility of making a payment on that loan when you get it. You don't have to make a payment unless you want to. And if you do want to, you have the additional flexibility if you can make that payment in whatever amount you want, in whatever interval you want. You could do it once a month, you could do it, for once a quarter, a couple times a year. So you have that flexibility, or you get a windfall of some income, you want to make some big payments against it, you can do that. So this has been the latest addition that we've had from now for a couple of years, where we can address that problem of either your income has been diminished as you're reaching retirement age, or you're a very successful business owner who's extremely successful in minimizing your federal income tax liability because of how much business expense you're writing off. But that doesn't mean you don't have the cash flow to meet the requirements for this kind of loan. And so that's really become a pretty good scenario for us. Is, again, that business owner is 60 or so, successful business, needs access, but the traditional HELOC is just not going to work.
Well, let's talk a little bit about some, I'm going to say, myths and maybe
Okay.
or some misunderstandings. And I'll bring one that my wife said. She said, well, if we're not making a payment and it continues to grow, at what point is our debt higher than the value of our home? And it seems like a valid point. But when we looked at the charts, if you could kind of give us an idea of why that is rare, or probably it won't occur.
Yeah, very good question. Part of what happens, and this is true with the HECM loans, the first mortgage, reverse mortgage, as well as the home safe second. There's a pretty extensive proposal package that is created initially when we have an inquiry. And part of that package is going to involve some very specific data to show you the numbers based on what's the available loan amount you can get. And it has assumptions about, you're not going to be making a payment. And so it's also going to have, as a result of that, it's going to show how the loan balance is going to grow over time. Because if you're not making a payment, what happens is it's a negatively amortizing loan, which, of course, as we all sort of have this trauma from '08, where negatively amortizing loans were like considered a key culprit in crashing the real estate industry with all those option arms, if you remember those. Well, a reverse mortgage is a negatively amortizing loan. So the idea is the proposal package will show you, if you don't make a payment, how that interest that's accruing, because there is interest being charged, just gets added back to the balance. So it's going to grow over time. Now, for one thing about a home safe second, in a lot of cases, the loan amounts are relatively small compared to the home value. And most of them we're doing is between 100 and 200,000. And so if you got a home that's worth $1 million or $1.2 million or something, and your first mortgage is only maybe 200 or 300,000, you're starting off with still a good deal of equity. And part of the proposal package also includes an assumed appreciation rate for your home. And the number that's used is 4%. 4% has been considered historically a pretty reasonable and conservative appreciation assumption to create these models for prospective home buyers to review and get a comfort level that they're not going to, in a short order, be suddenly underwater in value by, $200,000. What the package will show is, while the loan balance is growing, your home value at 4% appreciation is growing, and remarkably, it kind of maintains that equity level. It doesn't erode very quickly at all. And in fact, for it to erode to the point where maybe you will end up owing as much as what the home is worth, in most cases, these packages are showing, you got to get up to 100 years plus before that's even possibly going to happen. So, once you realize, and, the 4% number, if what have we been talking about now for a couple of years about how home prices keep going up, and it's been in the 4 to 5% range, even with higher mortgage rates. So that kind of validates that kind of assumption in these proposal packages, I think, is pretty reasonable.
Well, I want to ask you to step back in time here for a second, and I want you to go back to, let's say, the first 2 or 3 years of your being involved in the mortgage industry, and I want you to think back and think: did you ever think the value of homes in Southern California or across the country would be where they are today?
Well, I laugh because for one, I have to see if I can remember my first 2 or 3 years in the business. But seriously, I do remember. I mean, as I think I've mentioned on the show before, I got into the business right out of college. 3 weeks after my last college class in December of '81, I got in the business in January of '82, and went to work for a mortgage banking company located in Newport Beach by the well, I was going to say John Wayne Airport, but it wasn't called that back then. Interest rates were 17.5.
Wow.
Now, as a, coming out of college, naive, didn't know anything about anything. I mean, I didn't have any perspective as to that being a bad rate or a good rate because, I'd never bought a home, never borrowed a mortgage. I never, lent people money and so forth. So I didn't have any preconceived notions about, in my mind, it was like, well, the rate's the rate. I mean, it's 17.5. I mean, if you want a loan, you got to pay, that's the rate. But the key difference was at that time, and again, we're talking, 44 years ago, the median home price in Southern California was $64,000.
Wow.
So when you put those two numbers together, well, then, the resulting monthly payment wasn't too terribly bad. I mean, and what's really interesting is we dealt with that scenario of double-digit interest rates. It was not until, again, I got in the business in January of '82. It wasn't until 1986.
Wow.
When mortgage rates got to that magical single digit. It's like, oh my gosh, I can get a 9.875 rate. Hello, heaven. It's like, balloons. I mean, it was like everybody was ecstatic. And it was the summer of '86 or the spring to summer of '86 when the industry experienced the first real refi boom. Because, when I think I've mentioned on the show before, when I first got in the business, refinancing your mortgage was not a common transaction.
Hmm.
It was looked at almost in a negative light, like, oh, you're refinancing your home,
Oh,
you
really?
having financial difficulties or something. I mean, it just
Huh.
it wasn't a real, major part of the mortgage origination business at the time. Well,
Hmm.
1986 was the first, again, refi boom, and it was an explosion because, again, we got under 10% after 3 or 4 or 5 years of being double digit and closer to 20%. And so, you know, literally, I mean, and of course, we're talking about these in the days when, credit reports were still like typed, and it could take 6 weeks to get a credit report.
Oh my
It could
gosh.
take a couple of months to get an appraisal. I mean, you know, the industry wasn't automated to it. I mean, we still had IBM Selectric typewriters on some of our desks. So, and it took forever to get these refis done. And of course, it's ever since then, refi has become a major component of the industry. But before that, it wasn't.
Well, the reason I bring that up is because this next thing I want to point up here says the median home equity for senior homeowners age 65 and above is about $250,000, and the reason I bring that up is because when you talked about the median price home back in '82 of $66,000, and now the median price home is how much?
Well, of course, it varies by market. I think nationally, the number is somewhere in the mid to high 400s. I've looked it up here in my local market here, our local market here in the Coachella Valley, the greater Palm Springs area. And the median home price, when you take into account all 9 cities in this valley, it's more in the range of about 600 plus.
Wow.
And of course, you have certain cities that are way up there, Palm Springs, or a lot of multi-million-dollar homes, and same with Indian Wells and so Rancho Mirage and so forth. But so the idea is that of course, keep in mind, median isn't an average. Median is sort of the midpoint between those with the lowest amount of equity and those with the highest. So it's the midpoint. And so
Mm.
what that underscores, that 250 is a significant number. So what that would mean is, the median home price is home value is 600, and the median home equity for seniors is 250. Well, again, that means they've got a reasonably small first mortgage, and a good amount of equity they can tap into if they can just figure out how to do that. And that's where we come in. Again, in most cases, when it comes to getting equity loans, it's not too often that the loan amount being requested is really, really up there, because at some point there's some delta where it makes more sense just get a new first. Because if you get a large second and you've got an existing first at 250, 300,000, it's at 2.5. Well, if you need a $300,000 equity loan in a second position, uh, we'll do the math in terms of blended rate and tell you, no, you should get a new first and give up that
Mm.
low rate, because your new equity loan is going to basically overcome your first mortgage low rate, so that your blended rate between the two loans is going to be too high versus just getting a 6 3/4 new first mortgage with cash out. So we help people look at that as well, so that they can take the best execution about how to get that equity into their pocket.
Well, I think back in the day when my parents were, at that age, they were thinking about retiring. And something I think is, I don't know, you tell me, is this next one is highlight the importance of housing wealth in retirement planning and financial security. I mean, even to this day, I talk to people and I never say, well, I'm figuring in the equity of my home as my total retirement package. It's almost like it's two separate pieces. But if I decided to use it in a way like you're talking about it, like a home safe second or a reverse mortgage, it really does become part of the conversation, doesn't it?
Well, it does, or I think more correctly, we should say it should become more
Mm.
of the part of the conversation, because you have a little bit of this disconnect. You've got folks who have a lot of equity. Now, some of them are doing very well financially and have had a very good financial retirement plan organized and put together. Maybe they got substantial retirement accounts, IRAs, and so forth. But so those kind of folks, I think, forget that like something like a reverse mortgage could be another aspect of that financial planning. We've talked a while ago about the whole idea of how do you manage the risk of your retirement. You own a home, you got a lot of equity, and you maybe have a small mortgage and all that. but maybe you have substantial liquid financial assets, and perhaps you've set up a recurring distribution from those assets, like maybe a major IRA account or something, and you're using that money to live on. Let's say you're 70 plus, where you have to take a required distribution minimum amount anyway every year. Well, a reverse mortgage can be an extremely valuable financial tool for that kind of homeowner and borrower profile, because what you have to watch out for is, what if there's a major market correction that takes 20 or 30% off of that substantial IRA account that you're drawing money against to live on? Well, if you put a reverse mortgage in place, and let's say it's one, maybe you're free and clear, or again, you have a very small first mortgage, you get a reverse mortgage in place, and maybe it pays off your existing first, or you're already free and clear. What you do then is you set up a majority, if not all, of that reverse mortgage as a line of credit. And the unique thing about a reverse mortgage line of credit is they grow over time. The unpaid, or I should say the unused portion of it, grows over time. That's unlike a traditional HELOC that's not a reverse mortgage. And so then what happens is, when that market correction happens, and it will happen eventually, then what the homeowner can do is stop the distributions from that IRA that's just had a 30% plummet in its value, and move over to pulling your required monthly income out of your reverse mortgage HELOC, your line of credit, and continue to do that until the market correction, is, the value of your IRA has gone back up. So that way, it's something you can kind of toggle back and forth with, based on overall financial conditions, in the stock and bond market. So that's an example of a financially secure homeowner and borrower who doesn't think of a reverse mortgage as another tool to manage their liquid financial assets. And then the other big problem is somebody who's maybe not that well off. They have limited income. They're very worried. 71% of senior homeowners are worried about running out of money before they pass away. Well, if you're in that latter category, where your income is okay but not great, and you're kind of struggling a little bit, then the biggest obstacle, frankly, is getting over all the still extensive amount of misinformation and myths about a reverse mortgage. There's so many senior homeowners who are still scared of the product. They're worried about all their equity getting used, even though it should get used to help them enjoy the remaining years of their life. And then, of course, you got the other cross current of what does the family think about that? And you're trying to leave a legacy for your kids or whatever, and equity for them, but at the same time, you can't do that at the expense of not being able to live comfortably yourself. So you got to kind of work through all those different issues involved with tapping into that equity, so that both the homeowner and their family are all behind the idea. So I think that's the biggest obstacle, is just we've got to educate people more about, this is not a boogeyman type of a product. It can really, really help you if that's your major concern. If you're part of that 71% and you're worried to death that you're not going to have enough money, 10, 15 years more, this is the solution. And we can help people see that is really a safe, very reasonable product to use to address that biggest concern they have.
Well, it seems like that 71%, it from what you've talked about and what I've heard you say before is it really comes down to, they are in a situation where they really don't know the truths about what you've been speaking about. They they hear their friends. I mean, I know when we were talking about doing our reverse mortgage, that every day my wife would come home with a new gotcha. Like, okay, the gal told me this, or my friend told me this. I'm like, okay, I'll run it by Art, and Art would come back and say, no, Jeff, that it's just not that way anymore, and so I think it is out there like that there is again, 71% of the people out there are concerned about running out of money with their lifetime, yet they're setting on trillions of dollars of equity in their home because they're not using it in that planning process like you've just described. I think that's brilliant. Just setting up and saying, hey, I know I have this. It's almost like setting up another retirement account, except it's the equity of your home.
Yeah, exactly. I mean, with the reverse mortgage, the HECM reverse mortgage, if you set up that line of credit, I mean, it's a rainy day fund, basically. because we'll see a borrower that's, they'll have maybe, I don't know, a decent amount of money in a savings account. Maybe they got 50 or 60 or 80,000, and they're 60 years old, and we're pulling their credit reports because they want a HELOC, because they want to consolidate some debt. And you know, and then when I pull the credit report and they got $45,000 of credit card debt, well, the first thing that jumps out at you is, why do you have 80,000 in a savings account and 45,000 in credit card debt? Forget about how much equity you have in your home. The first thing any financial advisor would tell you is, you can get a 20+% rate of return on your money if you take 40,000, 45,000 out of your savings account and pay off that credit card debt. Now, you're going to only have 35,000 left over in that savings account, which creates anxiety because you feel like that's not enough money in savings. I'm going to run out of money. Well, maybe that's where you look at the reverse mortgage, uh, and then get that set up. And then if it's set up as a line of credit, um, you don't have to tap into it right away, and it grows over time. So that kind of replaces that savings account, so that you have access to it when you have a need. But in the meantime, you're not accruing interest, and that loan balance is not going up. So again, that's sort of some of the details of how these can work to your advantage. And our role is to help homeowners understand those advantages clearly, so they can keep them in mind as a strategy to solve some of those financial issues they're dealing with.
Well, before we get off of this, I want to make sure to put your information up there. This is Art's information, 760-969-5023, and that gets you to Art to talk about this. But before we leave today, I want to talk about those people who are not in this demographic you're talking about, because as we dug into this, and this is pretty fresh stuff, the other people that are younger, those dadgum kids, there's $11 trillion in total home equity for those homeowners, which is, as it says, is a record high.
Yeah, exactly. And of course, we might want to, for everybody who's watching and listening, we might want to define tappable equity. Tappable equity basically is the idea of measuring all these homeowners, how much equity they have, and then essentially taking a 20% haircut. So in other words, tappable means how much money you can take out of the equity in your home, so that your total mortgage debt will then equal 80% of your value. So you're still retaining 20% of your equity. So that, what that of course means is, take 11 trillion divided by 80, the actual total available debt, not tappable, but total available, not debt, equity, is a lot higher than 11 trillion. It's going to be probably like similar to the senior homeowners, probably 14, 15 trillion, 11 trillion of which is tappable. And so that's, again, another great example of an opportunity in the housing market now, that I think there's a pretty good focus on it, but there still could be more. Because again, ad nauseum, we've been talking about all these homeowners who are locked up. They don't want to sell. Maybe they need to, they would want to, bigger home, whatever, or nicer home. They have this other option. I mean, there is so much equity they can tap into. And what's really remarkable is, everyone's complaining about, I keep hearing it on the news and seeing on financial news feeds about, we're a 7% mortgage rate market. Well, not really. We're at 6.5%, everybody. We're not at 7. And when it gets into equity loans, they're not much worse. I mean, some of these equity loans, I mean, I can do a fixed line second equity loan in the 7s. I can do a variable HELOC. It's going to be in the 8s. That's not too far off of first mortgages. And if you have a need, you don't want to give up that 2.5% mortgage. You got $600,000 of equity. The opportunity to tap into that, get 100, 200. There's so many things you can do with it. And we're really trying to get people to realize that and raise awareness that you have that option. And then you can be very creative in all the ways you can use those funds. We went over that top 10 list last week. For the senior homeowners, about how they can use, say, a home safe second situation. Well, those younger borrowers have the same opportunity. Now, they can't get an equity loan that's going to feature no payment required. You are going to have to make a payment. You have to pay it back. It's a traditional loan. But I think more people need to take advantage of this, because that equity is there.
Well, I'll tell you what, I think it's a great thing. As you're talking about this, it reminds me of someone I know very, very, very closely. We just did a podcast together about a half an hour ago, and they were moving. They were going to move out of California to Arizona. They have a place in Prescott, and they had everything dialed in. And I saw her last week, and she said, "I've got news." I said, "What's that?" She said, "We're not going to sell our house. We're not going to move." I said, "Whoa, that's a big surprise." She said, "Because of the rate." And she said, the market over there is almost the market here. Unlike, hey, you sell in California, you can go pay cash for something over there. Well, she has a home that is almost free and clear. Like, I think she would be a perfect candidate for what you're talking about, of saying, hey, use that as a line of credit, and it
Right.
would make a difference. I'll have to have her talk to you. So I think there's probably there's tens of thousands of those people out there that need to talk to you.
Yeah, I think so. And the other bit of advice for any homeowners looking at getting an equity loan, whether it's a fixed rate second or a HELOC, I would urge you to be a little careful on what you're being quoted in fees. I mean, I had a homeowner contact me yesterday. She's a single woman, has a lot of equity, and she needs some. She's trying to get a HELOC because she admittedly needs to consolidate some credit card debt. And it was interesting because she was working with another lender, but somebody asked her to call me. So I went over what kind of terms she was being quoted, and it was a little bit startling. I mean, she was telling me she was getting a rate quoted of like 9 7/8. Her credit score was okay, but not great. But she was being quoted over $7,000 in points and origination fees.
Oh my goodness.
And so I did the math, and it was like literally close to 6 points. And what I pointed out to her, given the loan amount she was getting, is that she would be better served to at least consider taking a higher rate and reducing those points, because the difference in payment's not going to be that severe. Now you're going to have the emotional reaction to not 9 7/8, it's going to be 13. Oh my gosh, that sounds awful. But if you're paying off 25% credit card debt, 13 is not so bad, especially if you can get it at no points, no origination fee, which is what I could do for her. And
Wow.
when I told her what the difference in payment was, she was like, "Oh, that's not so much." Well, yeah. So wouldn't it be better to keep that $5,000 or $6,000 in your pocket? Why pay it toward lowering the rate when it's not going to get you that much in terms of monthly savings? It doesn't financially compute. So
Hmm.
a light went off with her. So I think we're going to be able to help her. And that's what I would urge, because almost all equity loans and HELOCs that we originate are going to be 0 points. If we're going to originate one with points, we're typically not going to be more than 2. And yeah, there could be some benefit for paying a couple of points to get the rate down, maybe a 3/8 to 0.5%. But again, that's something we help that homeowner do the financial analysis and help them decide which option is going to be best.
Well, Art, thank you very much. I know we probably went over on this, but I think it was worth really drilling down this and getting into the weeds today to talk about this, because it is, when you shared the number of 71% of the people of 65 and older are fearful of running out of money before they run out of time.
Right.
That's wild. And then to see how you've shared the numbers that are available to them, how much money they have in their homes, it's just staggering. So I really appreciate you taking the time today and really helping with the education process. I hope it's going to help some people. Thank you.
Yeah, I think I hope so too. I think we'd love to help people in these circumstances. So yes.
I'm putting your information on there again, and then I appreciate it, and I'll see you next week.
Okay. Thanks, Jeff. Thank you, everyone, for watching this week's Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Have a good weekend. It looks like it's going to be a toasty one, and I look forward to seeing you next week on the Mortgage Minute by Art Alvarez at Mortgage Works. Thank you.